Ladies and gentlemen, what if I told you that one move by Russia could reshape the entire gold and silver market, and most investors haven't grasped the implications yet? While the headlines focus on sanctions, geopolitics, and central banks, a much bigger shift is taking place beneath the surface. History shows that when nations begin changing the rules of money, capital moves, confidence changes, and entire financial systems can be transformed. If you own gold and silver, this isn't just another news story. It may be a signal that the global monetary order is entering a new phase, and that's what we're going to explore today. For decades, investors have been taught to view the global financial system as something permanent, almost as though the structure that emerged after the Second World War was destined to last indefinitely. That assumption has always been flawed. History is not a straight line. Every major monetary system eventually reaches a point where political interests begin to outweigh economic cooperation. When that happens, fragmentation follows. What we are witnessing today is not an isolated event tied to a single country or a single political dispute. It is part of a much larger historical cycle. The tendency is for analysts to focus on the daily headlines, but those headlines often distract from the deeper forces driving change. The real issue is confidence. Every monetary system, regardless of how sophisticated it appears, ultimately rests on confidence. Once confidence begins to erode, participants start searching for alternatives. Throughout history, economic power and political power have never remained concentrated forever. Empires rise, expand, and eventually face challenges from competing centers of influence. The same pattern repeats regardless of geography, technology, or ideology. The names change, but human nature does not. Governments always seek greater control while capital constantly seeks greater security. This tension has existed for thousands of years. The current environment reflects that same struggle. Nations are increasingly questioning whether they should remain dependent on systems that can be influenced or controlled by external political decisions. This is not a matter of ideology, it is a matter of self-interest. Every government's first priority is survival. When policymakers perceive vulnerability within existing structures, they begin building alternatives. Many observers mistakenly believe these developments appeared suddenly. They did not. The process has been unfolding for years. Financial sanctions, restrictions on capital movement, limitations on international transactions, and geopolitical tensions have all contributed to a growing perception that the global system is becoming less neutral. Whether that perception is right or wrong is almost irrelevant. Markets react to participants' belief, not necessarily to what policymakers intend. Once trust begins to weaken, diversification follows naturally. Countries seek alternative trading arrangements. Businesses search for new payment mechanisms. Financial institutions expand relationships beyond traditional networks. These actions are often gradual at first, but they create momentum. Over time, what begins as a precautionary measure evolves into a structural shift. This is where many analysts misunderstand the situation. They assume the world is moving toward complete separation. History suggests otherwise. Financial fragmentation rarely produces total isolation. Instead, it creates multiple centers of influence operating simultaneously. Capital flows become more complex, trade routes adapt, investment patterns shift. Rather than one dominant framework, several competing frameworks emerge. The consequences of such transitions can be significant. During periods of monetary realignment, volatility tends to increase. Investors become uncertain about which assets will preserve value and which institutions will maintain influence. Governments respond with new regulations, new agreements, and new policies. Yet these measures often address symptoms rather than underlying causes. The deeper issue remains confidence. When participants question the long-term stability of a system, they begin reallocating resources. This process can continue for years before becoming obvious to the broader public. By the time headlines acknowledge a major transformation, much of the adjustment has already occurred. History provides numerous examples. Trade networks that once appeared unshakable eventually gave way to competing arrangements. Reserve currencies that seemed permanent eventually lost their dominance. Financial centers that controlled global capital for generations eventually faced challenges. None of these transitions occurred overnight. They unfolded through a series of decisions made by governments, institutions, and investors responding to changing incentives. What makes the current period particularly important is the scale of global interconnectedness. Modern financial systems are deeply ingrained. As a result, even relatively small shifts in behavior can have far-reaching effects. A change in reserve management, trade settlement practices, or cross-border investment strategy can influence markets thousands of miles away. This creates an environment where traditional assumptions become increasingly unreliable. Investors accustomed to viewing the world through the lens of a single dominant system may find themselves confronting a more fragmented reality. Capital will continue moving, but the direction of those flows may differ substantially from what previous generations experienced. The mistake is assuming that fragmentation automatically means collapse. History does not support that conclusion. Systems evolve, power redistributes, economic activity adapts. The challenge for investors is recognizing these changes before they become conventional wisdom. What matters most is not the political narrative surrounding any individual event. Political narratives change constantly. The underlying trend is far more important. Nations are seeking greater autonomy. Institutions are diversifying relationships. Capital is responding to perceived risks and opportunities. These forces collectively point toward a world less centralized and more multipolar. Such transitions are rarely smooth. They create uncertainty, and uncertainty often leads to volatility. Yet volatility is not merely a source of risk. It is also a source of opportunity. Those who understand the cyclical nature of history are less likely to be surprised by developments that appear shocking to others. The lesson is straightforward. Financial systems are not permanent. Monetary arrangements are not permanent. Political alliances are not permanent. What endures are the recurring patterns of human behavior. Confidence rises and falls, power concentrates and disperses, capital seeks safety in return. These cycles have repeated throughout recorded history, and there is little reason to believe the present era will be any different. The world is not witnessing the end of economic globalization. Rather, it is witnessing its transformation. The structure that governed international finance for decades is facing increasing pressure from competing interests and competing priorities. Whether that process accelerates or slows will depend on future events, but the direction is becoming increasingly difficult to ignore. The fragmentation we see today is not the cause of change. It is the visible symptom of deeper forces that have been building beneath the surface for years. One of the greatest misconceptions in the investment world is the belief that gold and silver rise simply because inflation increases. That explanation is convenient, but history shows it is far too simplistic. If inflation alone were the driving force, precious metals would move in a predictable fashion every time consumer prices increased, yet that is not what happened. There have been periods of high inflation when metals underperformed expectations, and there have been periods of moderate inflation when they surged dramatically. The difference has always been confidence. Markets are ultimately driven by human behavior, and human behavior is driven by trust. People trust institutions until they have a reason not to. They trust governments until policies begin creating uncertainty. They trust currencies until they question whether those currencies will preserve purchasing power over time. Once confidence starts to weaken, the search for alternatives begins. That process is not emotional, it is a rational response to uncertainty. Throughout history, precious metals have occupied a unique position because they exist outside the promises of governments. A currency represents an obligation of a state. A government bond represents a promise to repay. A bank deposit represents confidence in a financial institution. Gold and silver, by contrast, do not depend on anyone's promise. They are assets that stand on their own. This characteristic becomes increasingly important during periods when trust in institutions begins to erode. The pattern has repeated itself across centuries. Whenever governments accumulate excessive debt, expand monetary policies beyond historical norms, or become increasingly interventionist in economic affairs, investors start to reassessing risk. At first, these concerns remain confined to a small group of observers. Most people continue operating as though nothing has changed. Eventually, however, the realization spreads that policies once considered temporary have become permanent features of the system. This is where confidence becomes critical. A financial system can withstand a great deal of stress as long as participants believe policymakers remain in control. The moment that belief weakens, behavior changes rapidly. Investors begin shifting capital. Institutions adjust reserves. Businesses reconsider long-term planning assumptions. These actions create momentum that feeds upon itself. The important point is that precious metals are often responding not to inflation itself, but to the declining confidence that accompanies certain policy decisions. Inflation is frequently a symptom rather than the root cause. The deeper issue is whether people trust the institutions responsible for managing economic stability. When that trust diminishes, demand for independent stores of value tends to increase. Silver follows many of the same dynamics, though its behavior can be more volatile. Because the market is smaller and influenced by both monetary and industrial demand, price movements often become exaggerated compared to gold. During periods of rising confidence, silver may lag. During periods of growing uncertainty, it can accelerate rapidly. This tendency has appeared repeatedly throughout financial history. What many analysts fail to recognize is that confidence does not disappear overnight. It erodes gradually. Governments rarely lose credibility because of a single event. Instead, a series of decisions accumulates over time. Each intervention, each policy adjustment, and each unexpected consequence contributes to a broader perception that the system is becoming less predictable. Predictability is one of the most valuable qualities any financial system can possess. Investors can tolerate high taxes, strict regulations, or even economic downturns if they understand the rules. What they struggle to tolerate is uncertainty. When the rules appear to change frequently, confidence weakens. Capital dislikes uncertainty more than almost anything else. This is why precious metals often attract attention during periods of political and economic transition. Investors are not necessarily expecting catastrophe, they are responding to uncertainty. The distinction matters because media narratives frequently portray interest in gold and silver as evidence of fear. In reality, it is often evidence of caution. Market participants recognize that confidence is shifting and adjust accordingly. The global debt environment provides another important factor. Governments around the world have accumulated obligations at levels that would have been considered extraordinary in previous generations. Servicing these obligations becomes increasingly difficult when economic growth slows or borrowing costs rise. Policymakers then face difficult choices. They can reduce spending, increase taxation, expand borrowing, or pursue monetary solutions. None of these options are politically easy. As these pressures build, investors naturally begin evaluating the long-term implications. They ask whether future policies will preserve purchasing power. They question whether existing financial assumptions remain valid. The answers to those questions influence capital allocation decisions far more than short-term economic statistics. What makes this environment particularly significant is that confidence operates globally. It is not confined to a single country. Investors compare policies across jurisdictions. Capital moves internationally in search of stability, opportunity, and protection. As a result, shifts in confidence can influence markets on a global scale. History repeatedly demonstrates that major turning points occur when public perceptions change. The underlying problems often exist for years before becoming visible. Debt accumulates gradually, policy distortions develop slowly, confidence erodes almost imperceptibly. Then suddenly, what seemed impossible becomes obvious. Market behavior adjusts because participants recognize realities that have been developing beneath the surface all along. This is why understanding confidence is more important than focusing exclusively on inflation statistics, interest rates, or economic forecast. Those variables matter, but they are often secondary indicators. The primary driver is trust. When trust is strong, financial systems can absorb significant challenges. When trust weakens, even relatively small disruptions can have outsized consequences. Gold and silver have endured through every major monetary experiment because they occupy a role that transcends politics and policy. They are not dependent upon election cycles, central bank statements, or government promises. Their appeal tends to grow when confidence in those institutions declines, not because investors expect immediate collapse, but because they recognize that uncertainty is increasing. The lesson is one that history teaches repeatedly. Monetary systems change, governments change, economic theories change. Confidence rises and falls in cycles just as markets do. During periods when trust is abundant, precious metals often receive little attention. During periods when confidence begins to fade, they move back to the center of the conversation, not because the metals themselves have changed, but because perceptions about the stability of the broader system have changed. And in every era, it is those shifts in confidence that ultimately drive some of the most important movements in financial markets. Most investors spend their time focusing on the wrong things. They watch television debates, follow political arguments, and obsess over economic statistics that are often revised months later. They believe markets move because of headline speeches or the latest expert prediction. Yet, if history teaches anything, it is that markets are ultimately driven by capital flows. Money moves first, and the explanations usually come afterwards. The mistake is assuming that markets are controlled by a single factor. They are not. Markets reflect the collective decisions of millions of participants responding to changing conditions. Some are seeking safety, others are seeking growth, some are preserving wealth, while others are speculating. The interaction of these decisions creates trends that often appear mysterious to those focusing only on surface-level events. Capital is constantly searching for the best combination of opportunity and security. It does not care about political narratives, ideological preferences, or media opinions. It moves according to incentives. Whenever investors understand these principles, they gain a significant advantage because they stop asking what should happen and start asking where money is actually going. History provides countless examples. Economic booms are often attributed to innovation, policy changes, or strong leadership. While those factors can play a role, the deeper drivers usually the movement of capital into a particular sector, region, or asset class. Likewise, economic downturns are frequently blamed on specific events, yet they often begin because capital quietly starts leaving long before the public notices. The challenge is that capital flows are not always visible immediately. They develop beneath the surface. Institutional investors adjust allocations. Large funds rebalance portfolios. Central banks alter reserve strategies. Corporations change investment plans. These shifts can occur months or even years before the broader market recognizes their significance. This is why the crowd is almost always late. Most people wait for confirmation. They want certainty before taking action. Unfortunately, certainty usually arrives only after the majority of the move has already occurred. By the time everyone agrees on a trend, the opportunity is often diminished substantially. The real advantage comes from understanding the forces that attract and repel capital. Investors tend to focus on prices, but prices are merely the result of money moving. To understand future trends, it is necessary to understand why capital chooses one destination over another. Confidence plays a major role. Capital prefers environments where rules are predictable and property rights are respected. It seeks stability, transparency, and the expectation of future returns. Whenever these conditions improve, money tends to flow toward them. Whenever they deteriorate, capital begins searching for alternatives. This principle applies globally. Capital is not confined by national borders in the way many people assume. Modern financial markets allow enormous sums to move across jurisdictions with remarkable speed. Investors compare opportunities worldwide. If one region becomes less attractive, money often relocates elsewhere. The result is a constantly shifting landscape of investment flows. Many analysts make the mistake of focusing exclusively on domestic conditions while ignoring international trends. Yet, some of the largest market movements originate from changes occurring thousands of miles away. A shift in reserve management, a change in regulatory policy, or an alteration in international trade relationships can redirect vast amounts of capital. These developments may seem unrelated to local markets at first, but their effects eventually become visible. One of the recurring patterns throughout history is that capital tends to concentrate before major turning points. During periods of optimism, money floods into the assets perceived as safest or most profitable. Valuations rise, confidence grows, the prevailing belief becomes that the trend will continue indefinitely. Yet excessive concentration often creates vulnerability. Once perceptions begin changing, capital can reverse direction with surprising speed. The crowd rarely sees these transitions early because it tends to extrapolate recent experience into the future. If an asset has been rising for years, most people assume it will continue rising. If a region has been attracting investment, they expect that trend to persist indefinitely. History demonstrates that such assumptions are frequently wrong. Markets operate in cycles because human behavior operates in cycles. Confidence expands and contracts. Optimism gives way to caution. Fear eventually turns back into confidence. Capital responds to these emotional shifts often before they become visible in economic data. Understanding this process requires looking beyond daily market noise. Short-term fluctuations can be distracting. Headlines create the illusion that every event is significant. In reality, many news stories have little lasting impact. The more important question is whether a development alters the direction of capital flows. If it does, the consequences may be substantial. If it does not, the market often moves on quickly. This perspective changes how investors evaluate opportunities. Instead of chasing popular narratives, they focus on identifying emerging trends in capital movement. They ask which sectors are attracting investment, which regions are gaining confidence, and which assets are benefiting from changing perceptions. These questions often provide more useful insights than traditional economic forecasts. Another important lesson is that capital rarely moves all at once. Large transitions unfold over time. Early stages often appear insignificant because the amounts involved seem small relative to the overall market. Gradually, however, momentum builds. Additional participants recognize the trend and join it. What began as a subtle shift eventually becomes a dominant force. The greatest opportunities often emerge during these early phases because expectations remain anchored to the past. Most investors continue viewing the world as it was rather than as it is becoming. They fail to recognize that capital has already started moving in a different direction. By the time the evidence becomes overwhelming, the adjustment is well underway. This is why successful investing is not primarily about predicting specific events. It is about understanding behavior. Capital leaves environments where risks are rising and moves toward environments where opportunities appear greater. The process is continuous and relentless. Political systems change, economic conditions evolve, new technologies emerge. Throughout all these developments, capital remains focused on preservation and growth. The investors who consistently position themselves ahead of major market shifts are usually those who understand this principle. They recognize that the most important signal is not what commentators are saying, but what money is doing. Capital flows reveal priorities, expectations, and perceptions long before those realities become obvious to the broader public. History repeatedly rewards those who identify these movements early. The crowd waits for certainty and receives confirmation only after opportunities have largely passed. Those who study capital flows, however, gain a window into the forces shaping future trends. They understand that markets are not driven by headlines, but by the movement of money itself. And in every major cycle, it is that movement of capital, not popular opinion, that ultimately determines where wealth is created and where it is lost.